Hi everyone, welcome to the Fotis Trading Academy. In this short video, we aim to show you how we use macro intelligence and what is the process we follow to identify high probability setups in the markets. Our purpose is not just to look around 20-30 different instruments and trying to figure out which market, which instrument to focus and which one to trade. We should be able to understand what is moving the markets and what is the catalyst that is affecting prices. We need to understand fundamentals first, we need to understand the current macro regime and then move forward and use technical analysis to pinpoint the entry and manage the risk. So let us show you how we do it just very quickly and what is the process we follow. And of course you can apply a process like this for your own trading plan. Step number 1, we need to understand the environment. Of course we have a very specific macroeconomic framework, a global macro framework, but let me show you something more practical. So we have an indicator like this, but you can see over here. At the Fotis Trading Academy we are using a proprietary scanner that we have developed ourselves that quickly scans all the different markets and instruments and shows us very quickly what is going on. For example, you can see in this table over here which markets currently are performing very well. You can see, for example, right now at the time of doing this video, Nikkei, DAX, Dow, the US index, dollar versus the Singaporean dollar, dollar yen, FTSE are performing very well. However, at the bottom, the underperformers is copper, gold, crude, the pound, and some other instruments. So just in one table, in one matrix, I can see what is going on. Where should I focus my attention? Then I can answer questions like, why is this happening? Why do we have a risk-on environment? Why do we have flows into equity markets? Why is copper and gold and crude, all the commodities, why are they performing so bad? But you can understand that just from this table over here, we have flows into equities and commodities are suffering. So if you are trading Forex straight away, you know where you should be looking for opportunities. For example, in this case, pay attention to commodity currencies. The Aussie, the Kiwi, the USD CAD and other emerging market currencies should not be doing very well against the US dollar. So in this way we are protected from randomness. We have a specific framework in mind. Let's try to answer some more qualitative questions like why is this happening? Look at these tables. We have here tables, I call them risk on, risk off and neutral. Maybe it's not exactly neutral, but this is just for the purpose of this exercise. The point is not how we call these tables. We just need to see the flows from a group of assets into another group of assets. For example, as I told you over here, I can see that at the time of doing this video, commodities suffer, crude down. I can see the rate of change in different time frames. Brent, copper, gold, silver. As I told you, commodity currencies are moving lower. Who benefits from this? Look at the US index. The US dollar is performing very well. I can see commodities are down, commodity currencies are down, dollar index is performing very well. Bond markets are moving lower, bond prices are moving lower, and at the same time we have flows into equities. We have some on the hourly rate of change, we have some small correction, but on a larger time frame like 4 hours and dailies, we can see that we have flows into equities. So this is very important, so we can understand what is going on. Let's review the correlations. So I'm clicking this over here. That's all done on a MetaTrader 4 environment. So I'm clicking Show Correlation Matrix. Let me click this again. Wait a few seconds. Let me move this so you can see the whole table. So bear with me for a second, please. So there you go. The table was quite big and you couldn't see all of it, but now I have moved the chart right. What can you see here? Let's try to explain some things. You can see that all equity markets, with the exception of China, today is the first day that China is performing a little bit better and we have a correction. But you can see very strong correlation between equity markets. They are all moving together. We have some small risk-on environment. You can see how commodities, gold, crude, copper, are negatively correlated to equities. So equities move up, commodities are moving down. What is the theme? I think the theme has to do with expectations regarding the Fed and higher interest rates. This is why also the dollar-yen, you can see it is moving together with equities. We have expectations for higher inflation, higher interest rates. China has been performing very poorly, commodities are crashing, and this has triggered flows into US assets. We have demand for US assets. This is why you see the US dollar is moving together with equities. Equities are moving up, dollar is moving higher, and dollar performs very well against the commodities. The more the dollar is moving higher, the more the commodities are moving lower. You can also see that, especially today, the 10-year bond in the US is moving the opposite way than the USD. So that justifies my theme that we have expectations regarding the Fed. But what I have just described explains what is going on in the short term. So we understand the environment, we understand what is happening now. We experience the current regime. Is this likely to continue? Is this theme that says that concerns about Chinese growth is causing commodities to move lower, like copper for example, dollar is moving higher because of interest rate differentials and because we have demand for US assets like equities, for example. But is this likely to continue? Is the US dollar immune to a spillover from emerging markets and China? I do not think so, and I will show you my objections and what I think. So in the short term, you can see if I click again this one, we go back to the previous table. So let me just move this right there so you can see the chart right. So you can see right now we have flows into dollar. Dollar behaves very well, especially against emerging market currencies and against commodity currencies. Plus we have flows into US assets. Is this likely to continue? I do not think so, and we had the warning signs yesterday when we had the news regarding building permits. Let me show you something. This is the technology sector, the ETF, XLK. We have flows into the technology sector. So stocks like Amazon, for example, let me type this, AMZ10. So let this show, okay, there you go. So new highs, Amazon is moving higher. What about Facebook? Sorry about this. So Facebook is moving higher. Yes, Amazon is moving higher. So in general, as I showed you, the technology sector performs very well. Is this likely to continue? What happens with other sectors in the US economy? Is the US economy heating up? I do not think so. Let me show you what happens with other sectors that are the canary in the coal mine. ITB. As I told you, we have the warning signs. ITB, the real estate, home builders, this is the home construction ETF. The symbol is ITB. Has moved lower from the peak back in January 2018, roughly 20%. Now, because of the positive sentiment, it is correcting higher, but keep in mind we have moved 20% lower from the top. We are outside the trend line. Building permits does not reveal a very positive outlook for the US economy. And this is the canary in the coal mine for the US economy. When the economy is growing, when the economy is heating up, there is an association between real estate activity, new home sales, and the actual growth of the economy. We see a divergence right now. This is not happening. Let me show you something else. When the economy is growing, transportation sector is performing well because we have goods traveling around the country. This is not going on right now. We are inside a triangular technical pattern. We moved 10% lower from the highs back in January. We are correcting higher, but we are inside this range. We are still much lower from the peak back in January 2018. What about some other sectors? What about the industrial sector in the US, XLI? Take a look at this. It moved down 10% as well. Now it is correcting higher, but look at this. Outside the trend line, and we have a series of lower highs. So yes, the technology sector is pulling everything higher, is pulling the indices higher, but if we take a closer look, what about airliners, home builders, the industrial sector, transportation? I do not think that things look so good. So we need to be very careful. Another reason that I'm cautious is I will go back to the correlations. So let me use the correlation again. Take a look at the correlation between the dollar yen and the equities. Right now, the dollar yen is very positively correlated with equities. And because I have a concern, a serious concern about the longer term implications in the US economy, I am not so eager to go ahead and go long the US dollar, especially against the yen. That doesn't mean that the dollar cannot rise higher. Of course it can, but it's all about probabilities. It's about reward and risk and probabilities. So let me go to the chart and show you, after we do this fundamental analysis, after we have understood very well what is going on, where are the opportunities and what are the risks, how we are approaching this. So let me show you this market profile chart over here. This is the Euro USD. Now, of course, the euro could move to 114, but I am not selling here. Let me do this and you can have a better look. Do you know why? We are at the bottom of the range. We are still inside the value area. The value area low, the value area we call the area where 70% of the volume has taken place, is around 115.40. Does this mean that the price cannot break lower? Of course it can. But as I told you, it's all about reward and risk. I'm not going to sell down here. The risk is all to the upside. I should wait either for a break outside the range and start looking for a short below 115.40. If the price is accepted there, that will be a sign that the sellers have taken control. Otherwise, for a break above 117.70 for a target of this huge high volume node around the highs at 122, 123. It's all about a perception of reward and risk. We are not trying to guess the direction. Where will it go? Will the euro go to 114? Who cares? Maybe it will, maybe it won't. What matters is how much we win when we win and how much we lose when we lose. Down here, unless it breaks, of course that will change my view, but if we stay inside this area without a break outside the value area low, I would be more inclined to be a contrarian and trade a long position to the upside. As I said, it's all about reward versus risk and where are we doing business. So if we are going to be if we are going to bet, let me rephrase, if we are going to bet heavily in favor of the USD, we must break below 115.39. This is the area that I would be looking to do business, below 115.40. That's an important area. Let me show you on the hourly what happens on a shorter time frame. On a smaller time frame, yes, right now it is exactly at this point. It is testing the value area low. Let's see what happens. If you are a seller, this is the worst area to do business, to try to sell the euro. Why? Because the buyers could return at this level and you could have a return back inside the value. And all the risk is to the upside, the other side of value, towards 118. So I need to see acceptance and rejection of this area from the buyers before I go ahead and start selling the euro versus the USD. So be careful about the right area. Now, dollar yen, this is very interesting. Similarly to the euro, this is not an area for me. Okay, let me do this so you can see better. This is not an area to look for a long. Why? I am concerned because of the very strong correlation with equities. And I'm not very optimistic about the equities. This is not a rally that relies on strong fundamental data from the US. We have risks. And as I said, the US is not immune. But the market price action has proved me wrong so far. I didn't take any trade. Sometimes there is a divergence between my fundamental view and price action. We wait. For example, a few weeks ago, I was looking to sell the dollar versus the yen, but I was doing it only outside the value. But it didn't happen, so I was protected. I didn't take any short positions. Market price action moved higher. It is consolidating right here at the highs right now. I will do business only if we have a break outside the value below 112.30. Let me move to a smaller time frame so you can see. Now you get an idea why this is a bad idea to look for a long position here. If you were long, it was a good idea, it was a better reward and risk to look for a long around 111.20, 111.30. That would have been a good area if you had a bullish bias. Right now, I notice this high volume node right here, this value area. I can see that the price is bouncing on top of the value area high. I'm not going to look for a short here. I will wait until this level is taken out. So this is now becoming an important level, 112.60. If the price is accepted below this level, it means that the sellers are taking control again, and I will be looking for opportunities. If I'm a little bit more conservative, I will be looking for a move below 112.20 to completely take out this high volume node here. So this is how we approach the markets. Now, our attention every week can shift from Forex to equity CFDs to bonds. It depends on the regime. Right now, we notice that the current structure of the markets, the current price action is a little bit choppy and volatile when it comes to currencies. We can see a better structure and a better pattern when it comes to equities. I'm going to show you the S&P 500. Now, this is a better pattern. Let me do this so you can see. The S&P is consolidating at the highs. You can see the strong correlation between the equities. Based on the fundamentals, I'm very cautious of doing business at these levels. Yes, the technology sector is pulling everything higher, but as I showed you, I'm looking at transportation, home builders, airliners, industrial sector, and I'm just not convinced. But that doesn't matter. It doesn't matter what opinion I have. What matters is where am I doing business. I will be looking for a move below the second standard deviation here, 2,803. I will be looking for a move back below. If you are a little bit more adventurous with a small risk, something like 0.5% or 1%, I would be looking for a move below this level, but I would be more aggressive only when we take this level out, if we move back inside the value area high. The level is 2,790. This is a very important level. If we are accepted, when I say if we are accepted, I mean price action. If price is accepted back inside this level and starts consolidating and drifting lower, that's the sign for me to go short. So I can see better opportunities from a reward risk point of view when it comes to equity indices. Take a look also at the Euro stocks. Look at the Euro stocks. It is not a sell yet. It is consolidating right on top of the value area high. It is at the top of the range. If we break and if we are accepted below 3,475, 3,475, that's the signal for me. I can see we have this valley here, as we say. That's my important support. 3,469. Below this level, I will be aiming for the bottom of value. Growth doesn't look very good in Eurozone. Price action moved higher because of the risk-on sentiment in the US, the demand for US assets. But I'm not optimistic at all when it comes to Eurozone's growth. Let me also show you one last chart. This is the FTSE. Now the FTSE is testing this high volume node over here. We have a point of control. The point of control is the place with the highest volume, right at the highs of the balance at 7,704. This is an important level. If this is rejected, again, I'm looking for a short. I have a bias for a sell. I am not pulling the trigger yet. I will be waiting for a move back below 7,684. And then again, I think the very important signal would be a move below 7,662. Sorry, let me correct this. 7,662. So below this, we will be aiming again for the bottom of the balance. So my point is, with this analysis, that we see better opportunities right now in equity indices from a structural point of view and based on correlations than Forex. Forex right now could be a little bit more choppy. We do have a bias, but the structure is not there yet. And we need to move to another area if we are going to look for a better reward to risk ratio. Thank you very much for listening, and please do not hesitate to contact us if you have any questions. Talk soon. Bye.